The brilliant thing here is if the Treasury does this, to make it plausible, they should stand buyer of last resort of all the gold that's coming to them at $15,000 an ounce. Now, that would be a brilliant move by the Treasury because, one, it's going to get a lot of gold that it wants in exchange for worthless paper, which you can print ad infinitum, via the Federal Reserve by just repeating the trick over and over again. So it's going to get a lot of gold onto its books. It's going to mess up America's, and it could turn into a rush. If they push the price of gold that much higher, it's going to become that much more difficult or that much more expensive foreign holders of Treasury bonds and bills to convert them into gold, or at least to get as much gold as they were getting at the old price. So in a way, it's mess with your enemies a little bit by putting the gold price at $15,000.
There's ongoing speculation that revaluing U.S. gold reserves could provide a financial boost. Investment analysts acknowledge the potential benefits of such a revaluation, even suggesting the move could establish a price floor for gold and subtly anchor broader financial expectations. Revaluing gold to $15,000 per ounce could inject multiple trillions of dollars into the Treasury. But commentators stress that this would dramatically devalue the dollar and erode credibility. This move would strengthen America's position, disadvantage foreign holders of U.S. debt by making gold more expensive for them, and potentially trap America's rivals while boosting U.S. reserves. Clive Thompson, a veteran market analyst and commentator, explains that the Trump administration may take out of its hat the reevaluation of gold reserves. This operation was carried out in 1934 by the Roosevelt administration to combat the Great Depression and its associated deflation. The mechanism was simple. The Treasury purchased the Federal Reserve's gold and issued gold certificates in return, which remain at the top of the Fed's balance sheet. At that time, the revaluation was able to inject $2.8 billion into the Treasury's coffers. Gold could be revalued from its current $42.20 per troy ounce to $15,000 or even $20,000, which could bring as much as around $4 trillion into the Treasury's coffers. A less heroic revaluation, from $42.20 to the current market value, around $3,500 per ounce, would bring less money into the Treasury's account, but with significantly less distortion to market prices. Combining the estimated effects of stablecoin regulation, which could lead to $2 to $3 trillion purchases of U.S. Treasury bills by issuers, and gold revaluation, which could bring in $1 to $2 trillion, the U.S. Treasury would have found the way to finance the extra debt deriving from the BBB, estimated to be around $3 to $5 trillion by the Congressional Budget Office. If gold were revalued to around $15,000, many would likely sell their gold to the Treasury and use the cash to purchase other assets, with silver being a prime target. Since silver's market is much smaller, this could send its price soaring, possibly matching gold's gains. Even without a gold revaluation, silver is likely to rise in value. Please like this video, subscribe to our channel, and turn on the notification bell when we play snippets from it.
No, I don't. I mean, the dollar will go down a little bit, but I don't think so. I mean, obviously it did in 1934 when they pushed up the price of gold by 69% in one day, and that caused effectively the dollar to be 51% lower. I haven't got the exact figure. In other words, the rate of the amount of pounds, dollar, pounds, euro. Well, it wasn't euros back then. It was the amount of pounds or Swiss francs or French francs that you could buy back then changed overnight, rather upsetting all the bankers in Europe who suddenly found that their dollars were worth that much less. But I don't think that's going to happen in the same way today. The world currencies are not linked to gold. So back then, the French franc and the British pound, all these other currencies were linked to gold. So when you reduce the amount of gold and dollar, the dollar's worth less. But today, all the currencies are linked to the dollar anyway. So not on a peg basis. The dollar would go down a little bit. It wouldn't make a big difference, and it certainly would not change retail prices, as a lot of people have suggested. Some people have said, wow, this would be terribly inflationary. There's no way it's going to cause any inflation at the retail price level, because although there'll be more money coming into the system, that money is going into the hands of the Treasury at the first instance. All it's doing, as far as the Treasury is concerned, not forcing them to borrow more money. So the money supply at the end of the day is going to stay fairly constant as the Federal Reserve and the Treasury manage the national debt between them. So the money supply isn't going to shoot up. And even if the money supply was going to shoot up, where's that money going to go to? It's going to go to financial assets. It's not going to go to the price of pizza. It didn't. If we go back into 1934 in America, the price of nothing changed because of this. The anticipation of what was going to happen changed the stock market price, but didn't change. It didn't change the cost of goods in the shop, and it won't change the price of goods in the shops again this time, because prices of goods in the shops are not linked to the gold; they're linked to paper money, and that's not going to change. First of all, on this scenario, if they do put up the price to $15,000, and it might not be in one go, but let's say they were to do that, and they're standing as buyer of the last resort at that price, on day one, there's going to be an awful lot of people tender their gold to the Treasury. And what are those people going to do with that gold, with that money that they get? They're immediately going to buy other things, and silver will be one of those things. The silver market is a much smaller market than the gold market. If they sell gold, people are going to buy, some of that money will go into the silver market, and that will accelerate the silver price to a high degree. So I think silver will do at least as much as gold. But what about if this doesn't happen and there's no special revaluation of gold? Do I think silver will rise? According to the Silver Institute, we can see the supply and demand of silver since the last few years has been in deficit. In other words, not enough is coming out of the silver mines to meet the demand for industrial use, other uses. So the extra silver which is needed to meet those needs has been coming out recycled silver. And that explains why we've seen a rising price of silver. As the price of silver rises, more silver gets recycled to balance the books. The deficit, according to the Silver Institute, and I've got no other source to go on, is going to grow larger. The reason it's going to grow larger is that the mine supply of silver is still in decline, and the industrial usage of silver is still on the rise, especially from electronics, where it's rising very rapidly. As that deficit gets larger and larger, more and more recycled silver, i.e. you and I melting down or taking our gold, or in this case silver, taking our silver in to be melted down, is going to have to happen. Otherwise the silver won't be there. And the only way they're going to suck it out is with the higher prices. So I think silver does go higher, whatever happens.
Speculation that the U.S. would impose tariffs on 100-ounce and 1-kilogram gold bars sent futures soaring to near record highs, only to reverse sharply once President Trump confirmed gold would not be tariffed. Futures dropped about 2.4%, and spot prices fell 1.2%, easing global market concerns. The clarification helped calm bullion markets, particularly benefiting Switzerland, one of the largest gold exporters. Still, analysts warn that lingering uncertainty and inconsistent policy messaging continue to challenge trading dynamics and investor confidence. UBS had previously warned that potential tariffs on commonly traded bar sizes could disrupt exchange for physical (EFP) trades. Short EFP holders may be reluctant to deliver physical gold to the U.S., potentially leading to short-term liquidity strains as they close out their positions. While the official statement dispelled immediate fears, some participants are cautious, awaiting a formal executive order to settle confusion and restore confidence in bullion trade flows. Now, let's get back to the interview.
One of the Swiss refiners wrote to the US Customs to say, can you just please clarify that the tariffs will not apply to gold bars? And the answer came back saying, well, probably apply. I haven't seen the text of the answer. I don't know if it's published even. But the answer came back along the lines of something like, well, 100-ounce bars and kilo bars will be tariffed, not the 400 kilo bars. Well, of course, what's needed in New York are the 100-ounce bars, not 100 kilos. What's needed in New York are the 100-ounce bars. What's coming out of London to be refined are the 400-ounce bars. So the bars go from London to Switzerland to be refined from 400 to 100 and from Switzerland to New York. So that the fear was that 100-ounce bars would be tariffed at 39%, which immediately drove the futures to a huge premium on COMEX in New York. There are a lot of shorts, and those shorts are consistently selling the futures. They've got the gold in London. Yep, no problem. They're fully covered in a certain sense, but they consistently roll the gold forward month after month. They buy back the spot month and roll it into the future month. But suddenly there's a worry. What if they have to deliver? Up until now, the thought's been, well, I've got the gold in London. I can always deliver if I need to. But now the fear fear became when this happened, oh my God, perhaps I won't be able to deliver. So these shorts rushed to cover their long position in the futures market, pushing up the futures to a very large premium compared with the spot market. And of course, there was a scramble to buy gold at the spot level. There was a clarification, I believe, from the president, and I haven't seen that actually. Well, what's happening then are those short panicking to buy back their futures and panicking to buy spot gold in New York while they could still get their hands on it, suddenly are now unwinding their positions. So they're selling the gold in the spot market, shorting again at the long end. So I think we're in a little bit of disarray, and that might explain why the gold price didn't rocket upwards yesterday on the news of this cut or quarter of the half point that Scott Besson wants. They're keeping very quiet about it, and it's shrouded in secrecy. Now, it might just be that there's an awful lot of people out there. I'd just like to have $350,000 gold bars in my basement, just in case.
Sure.
It could be. It seems like a funny thing to want. If you're worried about Armageddon, you'd probably want to have smaller coins. Because these bars which are being delivered are very expensive bars, my assumption is that it's large players who think that physical gold, is going to be hard to lay their hands on in the future, and think that if they have any sort of paper gold, they might not be able to get it at all and might lose the value of that in some way, shape, or form. So I'm guessing that it might be a government or governments. So what government might want to lay their hands on gold in New York? Well, it could be Mexico, it could be Canada. Canada's got no gold apparently, but it could be China. But obviously China, I think that would be a bit of a giveaway if they were buying it through New York. They'd probably buy it through London. But we have seen China buying every month. They bought again. They're not buying a great deal, but they're buying, I think, 60,000 ounces in the month of July, and 70,000 ounces in the month of June, and before that, 60,000 ounces a month.
The debate over gold revaluation highlights both its potential and its risks. While a move to $15,000 per ounce could inject trillions into the Treasury and strengthen U.S. reserves, it would also risk devaluing the dollar and unsettling global markets. Combined with policy experiments such as stablecoin regulation, the U.S. may be exploring unconventional tools to address its mounting debt burden. Meanwhile, silver could benefit indirectly from such shifts, while gold markets remain highly sensitive to policy signals, as seen with the recent tariff scare. In this environment, both investors and policymakers face heightened uncertainty and volatility. Could a large-scale gold revaluation backfire by eroding global trust in the dollar and U.S. financial stability? If silver rallies as a secondary beneficiary of gold revaluation, could it outperform gold in percentage terms? Please participate in the discussion and leave a comment below with your thoughts. If you found this video helpful, please like and subscribe for more videos.